Welcome to the Commercial Real Estate Podcast, powered by First National. I am Adam Powatic, sitting here with Aaron Cameron, live at the RealREIT conference. The video series portion of this is sponsored by Granite REIT. For those of you who are listening to the audio only, we are sitting with a very nice audio setup to record the bright, beautiful face of Brian Rosen, CEO of Colliers Canada. Welcome back to the podcast.
Thanks for having me here, especially for calling me a beautiful face.
Yeah.
Usually I hear a face for radio, so this will do.
This is a turn.
Yeah.
Well, I mean, last time we did this, and we have done this before with Brian, that was at the onset of the pandemic. For sure would have been done via video, although we didn't release the video portion, just the audio. You were relatively or very freshly minted in the brand new role, and had just had the grenade of COVID dropped in your lap. So this should be interesting because you've had a monumental change since then in the industry, and of course, I'm sure with the way Colliers is operating. So we're gonna go back a little bit, just retouch on some of Brian's backstory. It is an interesting one, and then get into what has happened since his first few weeks in the job, managing a once in a lifetime crisis.
Yeah, that was fun. I'll do it all over again. That's the oh wait, maybe not. It was great, as we talked about the last time. Kind of a little bit of a walking black swan. My background, every time I've had a major career transition, life transition, some major awful event has happened in the world. So whether it was graduating undergrad, the .com bust happening, I worked a couple of years, went to Avon Products, and then their stock price halved, and the Walmart shopper, which is their main demo, really had a tough time in 2003. So I went to business school and graduated 2008. Great financial crisis. Awesome. Figured, okay, I'm safe for a couple of years. Moved to Texas in 2013. Oil crashed. It was great. And then when I was interviewing at Colliers, I said to Jay Hennick, our global CEO, I said, Jay, something bad's going to happen. He kind of laughed and dismissed me. And then I got promoted to CEO in April of 2020. Put in the role in March of 2020, and then was closing offices 2 weeks later. So
we actually have breaking news. Right before we went live, Brian announced that he plans on retiring as the president and CEO of Colliers in about 30 years from now. So we're safe for a long cycle.
As long as I don't move jobs, the world is safe. So this is the ultimate in job security. Absolutely.
And you can't blame interest rates on him, because that happened long after he started at Colliers.
It's all part of the same routine. So no, we're all good. We're all good there.
What did you change that caused the interest rate environment that we're in today?
Oh gosh, I wish I could take credit for any of that, or I wish I can't take credit. But no, it's definitely been an up and down roller coaster for the first couple of years. It's been exciting. It's been great. In a lot of aspects, it's obviously been very challenging in a couple aspects as well. But I mean, resilience, that's we're celebrating our 125th anniversary, Colliers, this year, actually in September, I think, or October. So we've seen a few of these ups and downs over time. So, I can't really complain.
That's not much younger than Canada.
Yeah.
As a country.
Absolutely. I mean, we Articles of Confederation in the 1860s, which for decades, my father-in-law thought he had a relative related to one of the signers of the Canadian Constitution. Turns out he doesn't.
Don't say that, though. You could.
University of New Brunswick thought that he did too, and they had a whole storied history. Charles Fisher was great. Nope, turns out descended from just immigrants coming in the 1700s. Still pretty impressive.
That's pretty good.
But
that's pretty cool.
We thought we were Canadian royalty, and no, we're not. Unfortunately,
it really kills the dinner table conversation. When you're at a dinner party, that's a good gem to draw.
It was awesome. Ancestry.ca ruins lives yet again. Here we go.
So during our last conversation, we talked about the breadth of Colliers and how you've got so many different businesses inside the global umbrella, the Canadian umbrella too. Maybe just talk about all of the different types of interactions or relationships that Colliers has, and what you've done over the last sort of 2.5 years to kind of put your fingerprint on things.
Sure. That's one of the things that, even though, as I mentioned, we're 125 years old, but still a lot of the market still thinks of us as mainly a brokerage shop, which makes sense. I mean, it's the largest part of our business globally, as well as in
all those
Canada.
signs, right?
We have the property marketing. It's the best advertising out there. You walk by it, you see it. It's still great. But no, we spent a lot of time in the last 15 years building up a diversified business, building up property management, project management. Globally now, we're a really large investment management firm. Actually, I think we're up close to $100 billion of assets under management. So not much in Canada. Most of it's in the U.S. and the U.K. But even in Canada, a lot of that recurring revenue business complements the brokerage business really well. So when you have some challenging times like right now, where the transaction volume is lower due to the market conditions, we're able to ride that out and perform still pretty well, given the fact that we have businesses. Buildings still need to be managed, they still need to be built, infrastructure still needs to be built, et cetera. So
is that part of the resiliency you mentioned?
Exactly. So that's why we're able to ride the ups and downs. So when COVID hit during 2020, our property management business, they were just chugging along. Our project management business is mainly municipal government. It touches all sectors, but 80% of the business is public sector. That stays consistent over time. You have to still keep evolving and growing in different spaces there, but that business was a little bit more resilient. So that helped shelter during the tougher times of the transactional lulls. And then you have the years like 2021 where brokerage storms back and really helps pull the whole thing together. So it's a great blend, I find, and it's just for me fun as a CEO. I'm a people person, and I love the different types of people, whether it's a building operator, whether it's a junior broker, a senior broker, a project manager. The different types of people at Colliers, it's just it's a huge spectrum, and that makes it fun. Always a different challenge.
What's the head count now, Canada-wide?
Total, we're about 2,800 people. So we're coast to coast in 40 so offices. So it's sizable now, and different businesses. We have 3 big businesses that occupy probably about 2,100 of the total people. Our project management, property management, and brokerage. But yeah, no, we've definitely grown over time, which is great.
What does the executive look like? I was always comparing these things to First National's experience. We've been an executive of 6 people, which seems like a lot when we're sitting in those rooms trying to get consensus. With so many different business lines, what does that sort of executive team look like?
It's actually quite small and nimble relative to what you'd think. That's one of the things that attracted me to Colliers is we're not bureaucratic. We're enterprising. We are very entrepreneurial, very light overhead. My team, my CEO level, sort of my direct report, I have like a team of 4 or 5. Now I have my business unit presidents and functional leaders, but really it's outside of our 6 major business lines of marketing and IT. That's it. And people services, obviously, as well. So you get 10 people together in a room, you can actually make a lot of decisions and move a big company pretty fast when you get rid of the red tape. So it actually moves pretty fast.
Well, by virtue of, I guess, a lot of your employees being on a commission-driven structure, it attracts entrepreneurial people. You bog them down with red tape, and you're going to have a lot of conflict. So that is
100% true. But what's cool is actually Colliers, our non-brokers, our non-commission, non-appraisers are also very enterprising and entrepreneurial. And as an example, so we have 40 global partnerships. So we do a perpetual partnership model where we like having, instead of just buying a company outright, we'll partner with them, 65, 75% ownership. And that's not for everyone, right? So you have to find the right partner. So we just partnered with, in the U.S. a couple years ago, Mazars, big engineering firm. And they share our values. They're very enterprising, very entrepreneurial. Wouldn't be a fit to go with a large bureaucratic organization. That just wouldn't fit. So we have to find the like-minded. Harrison Street, very similar, very like-minded, very entrepreneurial investment management team. So it's funny. Everybody thinks it's only the brokers, but it's actually everybody in the organization, which can be tough. It has its 90% benefits, but the 10% of the sometimes ready, fire, aim, I will admit, we sometimes do that. But I'd rather pump the brakes on enterprising entrepreneurial spirit than try to coax that. You can't do that.
How much time do you spend on trying to communicate that culture and those vision and values? Like, is that an important part of your job?
Huge. I think the communicating values, my role really at the end of the day, I'm a people crisis manager, a talent developer, chief business development officer, and chief communicator. And at the end of the day, that's where I spend all my time. So yeah, communicating our value prop to our employees, to potential recruits, to clients. Hopefully I do a pretty good job. But that's my day job.
It's funny you mentioned a crisis manager in the mix.
Yeah.
Given the 3-year run here, but
Well, it's also a people business, right? Professional services. It's constantly there's a crisis at some portion of the business. Somebody is either you've done something wrong with a client, you've done something right, and the client wants to still take you to task, or two people are feuding in the organization. It's 2,800 people. Things happen.
yeah.
You don't get pulled in when everything goes swimmingly.
Rarely. I do get pulled in occasionally to do the high fives and the hugs and the handshakes and things like. Maybe not hugs, not during COVID, but definitely the fist bumps and everything. So sometimes that's the best part of the job.
Ring the bell for big sales. And,
Ring the bell. In our Montreal office, they get on a bike and they ride the bike around the office when they have a big sale. In our Montreal property management group, yep, that is an interesting. We have gongs in every office when we get some big sales. I haven't seen the team actually ring them. We've had big sales, but we got to get back to that tradition.
The
Wake
bike,
people up.
That's great.
The bike is great. No, I love that.
We need more of that at First National. Before we get into sort of today's market and what's transpiring, you mentioned your investment management team being much larger globally. Is there a reason why it hasn't picked up in Canada? Is it a more competitive market? Price doesn't make sense. Like what's the
small population?
Yeah, well, fair.
Well, there's the simplest reason actually is just the companies we've looked at and purchased, and so in the U.S. it's obviously there's a lot more opportunities. It's a lot more fragmented market for this. You can find a company with $15 billion of assets under management or form a partnership, and you're not breaking the bank. In Canada, there's many fewer options, right? And so the U.S. has been the largest focus so far, but Harrison Street is up in Canada, and we're looking to launch other products in Canada. But to date, it's been you swim where you go where the money is, right? And the U.S. has a lot more opportunities, so.
Not to get indelicate, but in terms of market share in Canada, how does Colliers stack up against other countries globally where you track it?
Well, first of all, I mean, being that this is where we were RBC bank account number 7, I think in 1898 when we got started as Macaulay Nichols. We've had the longest track record here. So here in Australia is probably our strongest position globally for major markets. So we like to think we have it's obviously it's a fragmented market, but depending on the business line, we have the top market share in a bunch of the different asset classes or businesses. I won't get into specifics because I don't want your viewers calling in from our competitors saying no, we're number one in this one. But I definitely the facts are facts, and we have had a long track record. So it's a strong market up here and good competitors. We feel we stack up well though.
It'd be interesting to look back and find out what total sales volume was back in 18.
I don't know what a house or a commercial building sold for back then with the horse posts where you had to put the horse on there. Whether that was what I can imagine though, the zoning process was still probably tough.
Yeah.
It wasn't. It was probably more build first. Ask forgiveness. Second.
I don't know. You got to rezone it to a saloon. I'm not sure what's going to be
We're
there.
still resolving some of them. Yeah.
We're still resolving some of the environmental on some of the things. Absolutely. Yeah.
Just, focusing on your sort of the global perspective of Colliers. How much time do you spend talking to your counterparts across the world, getting intel from them, finding out what's going on?
Not as much as I should, but we do have a fair amount of time. So our global CEOs, we do get together on a monthly basis. I have a close relationship with our U.S. CEO because obviously there's a lot more business that goes back and forth between the borders, sharing of clients, things like that. We're working with some U.S. We work with U.S. brokers on a lot of deals, et cetera. So there's definitely a global interplay. There's certain of our business lines too, which are more global in nature. Capital markets in terms of the global capital flows, those types of things. So there's a natural partnership between the businesses there.
Not to focus too much on the States, because of course this is a Canadian-focused podcast, but if you were to look at market sentiment amongst your brokerage, them being the ones that would have their finger on the pulse of transactions, they're going to come up in the market because they'd be first calls and people are thinking about selling 6 months from now. What's the optimism level in Canada versus the U.S. for what's going to happen next year?
I would say that it is a little bit more optimistic. It's hard to say because the U.S. by nature is naturally very optimistic.
Very true. Yeah.
I'm from New Jersey originally, and sort of that. Although after seeing the Giants play the Cowboys the other day, we're not very optimistic about
Don't go
many
there.
things.
Although the Jets got a win last night.
Yeah, but no real New York fan really roots for the Jets. Although Aaron Rodgers got hurt, that's a positive. So the the sentiment in the U.S. is a little bit tougher to read in that regards, but from what we're looking at the macro factors between the two, we do feel it'll be a little bit softer of a bounce in Canada than it will be in the U.S. We do feel the U.S. will have a little bit more of a correction potentially coming. There's a little bit more cracks based on the type of, I mean, you guys know this better than I do, right, in terms of the lending in the U.S. and the fragility there with the regional banking, with the non-recourse. It's just we feel there's a little bit more of a risk factor there. So there's optimism, but there's also a little bit of a lack of clarity and unsure about what's going to happen next.
Yeah, just maybe expanding on that a little bit, the CMBS market in the U.S., which is very strong. I mean, they kind of target a higher default rate. You're not doing it right unless you're getting some defaults. Versus in Canada, your goal is zero defaults. It's
Right.
It's just a different lending mentality. So of course they're going higher leverage, as you mentioned, non-recourse, and so seems to be more cracks. Maybe let's just go into what you're kind of feeling in the market. I mean, valuation is a big topic with interest rates up. So where are values, and what is your valuation team seeing? How are you guys kind of adapting to the sort of price discovery world that we're in right now?
You nailed the bingo line. If we have our bingo card of price discovery, bid ask, dry powder. I mean, it's all the terms out there. But no, it's unfortunately there's not a lot of comps. And so I'm seeing what everybody else is seeing, right? Where we like to say, well, here's where the values are at. Cap rates should be here. But unfortunately, just not much is still trading. So it's not a very liquid market, and you're not able to point to things and just say, oh, we're going to see cap rate expansion over here. Or we're going to see prices over here. So it's still buyers and sellers still have not found that equilibrium point of where they want to be. The privates are starting to get a little bit more aggressive, starting to move in. We definitely see certain buyers moving on things, but I wouldn't with confidence be able to say what indicative values are at this point. I mean, there's still a lot of folks that are trying to ride this out as long as possible so they don't have to mark to market on big portfolios, and others that are looking for opportunities. But just it's not yet resolved, unfortunately.
How much distress do you think is bubbling?
It's interesting. We keep asking that question. We keep expecting to see more distress, but we just so far have not seen much. Whether it's the banks doing the old extend and pretend, or if it's a little bit of just it's only been in some regards a year, not even, since really the magnification of when this came. So we almost need a little bit more time, which is what none of us want to hear, to see that work its way through, where you're now having 12, 18 months at the higher interest rates, a lot of the loans that are coming due in the next couple of years. So we've seen those mid-tier developers potentially who are a little stretched and expecting their values to go up and got there, but not much. There's not much that's out there from a fire sale, have to sell to cover their higher debt load. It's just not yet in the market.
Are your land guys busier than normal?
The opposite.
Really?
The opposite. So most clients are retrenching back to existing holdings. So they're focusing on their core assets. They're focusing on their core developments. And the land has been probably the hardest hit of the asset classes. It doesn't mean it's not trading. It just means no one knows what the value of the land is, so they're not investing in it. And they're like, I have a big enough pipeline of existing, so they're going with that.
Our founder,
Not what I expected.
Our founder Maury Taz has a saying. He says, "If no one's willing to buy it, it's worth zero."
Right. But people are willing to. The one difference on this one is people are willing to buy it. They just disagree on the price. They disagree. It's an asset that wants to be traded. Just the buyers think the discount's bigger than the sellers are ready to
No one
admit.
wants to make a big misstep.
No one wants
look
to
like
be
an
the first
idiot.
one. Exactly. The greater schmuck theory. No one wants to be the next schmuck over the line there. So this is okay. That's PG. For
Oh
this
yeah,
stuff.
no, you're good.
yeah,
No. The only person that's ever sworn on our podcast is now First National's president and CEO.
Well,
so
he's
I
allowed
think
to.
we've got permission.
He powers it, so it's
yeah,
okay.
exactly.
REIT privatization.
Okay, go then. Yeah, fair.
We are. I mean, I don't know if the mics are picking up the background noise here, but those are the excited REIT owners, investors, market participants behind us, so we should maybe jump into this a little bit. You mentioned REIT REIT privatization as potentially being in the mix in discussions, a viable option. What are your thoughts?
Yeah, I think it's absolutely a realistic possibility, particularly if we do see a hit to the U.S. market, where we do see a market, the equity market, take a hit, which no one's rooting for, by the way, at all, because obviously that has a lot more negative impacts. But if that does hit, where the prices are trading as the discount to NAV, and you're seeing that in the Canadian actually has a larger discount than in the U.S., but that discount is still high, and if it gets hit even more, there's just a likelihood that could happen.
So why would you privatize?
Well, right now there's no liquidity, so there's not been much action at all in the equity capital markets.
Meaning that no one wants to buy the stock.
Well, yeah, exactly. So, their stock is not worth as much to them as it historically was, so they're not able to leverage it for value. So they're stuck. They're some REITs, not all, by all
of
means.
Course.
Some are more illiquid right now, and they don't have the ability to have the freedom for capital raising that they would as a private company.
So forgive my ignorance. I mean, you talked about the discount to NAV being greater than historical, but isn't that just because they're all using inaccurate cap rates to value their assets? Like, is that right? What am I missing? So isn't it that they'd rather privatize than
actualize?
Yeah, actualize the true value of their assets.
Right. So that's where some of the disconnect is. What's the actual true value of these assets? Now, there's a lot of firms. I mean, you look at the Summit REIT, Dream, GIC privatization, and that's an industrial, and there's not going to be whatever it sorts out with the cap rate. No one thinks that there's going to be a massive cap rate expansion in industrial or multifamily. So, but there are still some REITs that are trading, and their cash flow, they're illiquid, and so they can use that injection of cash in there that will help them then pursue their growth strategy.
And is it a two-way street also, that they don't want to raise capital when there's such a big discount to NAV, in addition to less interest in actually purchasing it?
Yeah, the investor pool is not there where it was, and also the ability to raise money from that. So there's just the stock is devalued based on where it was. So it just creates a prime opportunity where you get these discounts where an enterprising firm with the right capital stack, and usually it's a syndicate, can come in and take a couple of REITs private, especially ones that are in certain asset classes that may be struggling in those asset classes. So a privatization just gives you more freedom to operate. So I wouldn't be surprised if we see more of that in both the U.S. and Canada.
And does this contain more to the smaller REITs, or the bigger REITs would be in play?
Anything really is in play. I not anything meaning any REIT, obviously, but I wouldn't categorize it as just for the small ones or just for the large ones, because it depends on the REIT situation, their asset mix, and where they are with their decisions and their strategy.
Do you have a team that helps with that process?
We do have a team that was not at all why I brought that up. We do support usually on the buy side, but that's not what I'm promoting.
No. I asked the question. Yeah. You didn't bring it up. And what does that process look like? So you would be approached by like investment managers. Who's coming to you? Private equity guys coming to you saying, "Hey, I got a bunch of cash. Do you know of anyone that wants to privatize? And let me talk to them."
Sometimes it works that way. For the most part, usually an enterprising investment banker will go out and look for the opportunities. If you're tracking the REITs, if you're doing that, you'll know which are the ones that are in a position that they may be willing to entertain something like this. Obviously, there's hostile and non-hostile privatization exercises, and who'd be more open to it, or who'd be a target. And then we work with a group of buyers or a single buyer. Usually it's a group, and then we would put together a process to either approach in a friendly way or a non-friendly way. And, it runs the gamut of what can happen.
I'm still struggling with this whole concept of what your discount to NAV is so great just because your NAV is wrong. Like, it's just, am I missing something? Is that?
Well, I guess the counter argument is not wrong, right? That's the.
Well, but it okay. All right, fine.
Well, but it
like
may
your opinion, man.
Yeah.
Well, but it may be wrong, but also it depends on your buying trajectory, right? So if the NAV discount right now, but if you're seeing a future value accretion, especially if you go private, if you do some distributions. You sell some of the not dividends, but you sell some of the assets, and you so. At the end of the day, it depends what your time horizon is. It depends what your value, your perspective of the value is.
Yeah, I'll remind our listeners, if you haven't listened to it or aren't aware, the big one, of course, is that the NAV doesn't include any projects under development.
Correct.
So you could have a gigantic pipeline, and of course the markets aren't recognizing that.
And that oftentimes that's what handicaps you too, because you have this massive development pipeline and you don't have the capital to fully realize the value on that. And so you're stuck. And so you actually become more attractive to a buyer who's sometimes two buyers. One buyer wants the existing income-producing properties, and the other part of the capital stack wants the development properties. And you can get a split, or you can just, how you carve everything up. It all depends on the situation.
That'd be a career-defining transaction, though, for somebody to put that together.
I'm sure it would be.
Yeah.
But look, I'm sure we'll see something in the U.S. We'll see something in Canada at some point. As you said, the mark-to-market will close that gap, obviously, on some of the NAV. But it again depends on your liquidity, depends on your strategy, depends on your development pipeline, all that type of stuff.
We're almost out of time. A couple of minutes left. So, crystal ball.
We want interest rate. We want cap rates. We want numbers.
Got it. So I'm going to hashtag not an economist.
Yeah.
And that's what I put on my LinkedIn all the time. Yeah, crystal ball is, I think we're in the middle of a cycle, and we will get better. The hardest part is pinpointing when. I do think once things start trading, there's a lot of capital in Canada, and there's a lot of positive momentum. And globally, Canada is an attractive investment target. It's been a closed market historically, but investors are looking at Canada more. So it's an attractive target for money. The question is just what are the right prices, and how do you start kickstarting the momentum? And I think a couple more months of stability of no interest rate changes, that's going to help a lot. And so I think Q3, Q4 could be a real starter engine for the real estate market. It just depends. It depends on the comfort level that people feel in terms of valuations and the interest rates. If we have confidence they're not moving, then I think you're going to start seeing some
Brian,
investment.
you just jinxed it. Now they're going to start rising rates because you said that, right?
I did not say they are stopped. I said if we see that.
Okay, all right.
If we don't see it, then yeah, it's going to keep pausing.
He's getting worse.
Look, as long as I stay in this job, you guys will be fine in the long run.
Okay, so let's just last thing then. When is the cycle turn? When does the upswing start again? 6 months, 8 months, 18 months? What do you think?
I'm sorry, I can't give you. I'm going to punt completely on this one.
Okay,
You escaped the trap. That
it's
was
okay. It was a total trap.
Trust me, I've gotten this one.
Somewhere between 3 and 18 months is what I would say. Yeah.
Will we have a recession?
Yeah,
it's like it's complex. So everything's fine. Well, it's complex. So the answer is I don't know.
Are you more pessimistic, more optimistic?
I'm absolutely more optimistic. I think 2024 will be a much better year for the commercial real estate market. I do think that, look, from our perspective on the services side, when things go up or down, when there's motion, when there's activity, velocity, we're okay because we're able to help our clients through it. So for us, it's a little bit different than the overall market. Obviously, when the market's going down, it's not good for a lot of property valuations and investment companies. But for us, momentum will be good. There's only so long that a closed-end fund can reconcile, and there's only so long that you can go and have your interest coverage at twice the rate. So I mean, at some point, things have to snap, and so that's why we're thinking 24 could be where it starts to move.
The Great Reset.
Correct.
We will use sleep as a barometer. 2020 was probably your worst sleep as a leader. 2021 would have been pretty nice. 2022, maybe third in line or second out of the lineup. So 2024, you're going to be well rested. Is that the idea?
Sure.
Yeah.
I've learned to go to sleep at night no matter what, because tomorrow will always bring another opportunity or another crisis, and I don't know which one. So might as well get my sleep.
Yeah.
I mean, it's only 5-6 hours, but nonetheless,
you still need it.
You still need it every night, and maybe on the couch, depending on what I did. But no matter what, the sleep is happening.
Out of time. Thanks, Brian.
No.
Really appreciate talking to you. That was great. Thanks for coming back on. I'd like to thank First National for powering the podcast, and thanks to Granite REIT for sponsoring the speaker series. Thanks again.
Thanks for having me, guys. Appreciate it.